Today's Talk About It Tuesday question is, can you explain Section 121 exclusion? Ooh, that sounds technical, but it's really super simple. But let me start with this. In creating your strategy for growing wealth, I think most people drop the ball when it comes to protecting the income that they create or protecting the wealth that's generated. And one of the greatest sources of loss of value, of income, of wealth is taxes. And I don't expect you to know every section of the IRS code. It will be impossible. The amount of tax code literally is so expansive. It could take you a lifetime to learn, and it changes constantly. So there are professionals who have dedicated their lives to not only studying and understanding the tax code, but also implementing it for your personal situation. So as a part of your financial planning, as part of your wealth development, you must include a way to preserve that wealth or minimize loss, not only from crooks and criminals, not only from making poor investment decisions or other types of losses, but protecting it from one of the greatest sources of loss, which is taxes. So Section 121, it's really simple. Section 121 is a section of the IRS code that says there is an exclusion of a certain amount of your capital gains from being taxed on the sale of a personal home. And I'll get to the details of that, but if you don't understand what capital gains is, none of this matters. So let's go back to go forward. So if you're talking about gaining wealth, you must understand what capital gains is, and then how capital gains is taxed as opposed to what we call ordinary income tax. So what is capital gain? A capital gain is what you get when you sell a capital asset for a profit. So what is a capital asset? A capital asset is pretty much anything you own for personal use or as an investment. So examples of personal use: a home, a car, your furniture, anything of value that you own personally is a capital asset. But also a capital asset can be your investments, stocks, bonds, investment properties, collectibles, things of that nature that you're only using for an investment. So here's the difference though. If you sell a personal use capital asset for a loss, meaning you sold your car for less than you paid for it, you sold your furniture for less than you paid for it, that loss is, you just eat the loss. If you have a capital loss for an investment, you get to write off the loss. And I know it doesn't seem fair, but that's one of the strategies that the wealthy use to mitigate risk. So you can take a risk on an investment, because if it loses value, let's say you buy a stock for a certain amount and the stock value goes down and you sell it, then you can write off the loss. But the flip side is a capital gain. If you sell your personal use capital asset for a profit, you have to pay taxes on it. If you sell an investment capital asset for a profit, you pay taxes on it. So you pay taxes on the capital gain. So what is the capital gain? Basically, to keep it simple, it's the difference between what you sold it for and what you bought it for. So that amount in the middle, not the entire amount, the difference between what you sold it for and what you bought it for is the capital gain. You have to pay taxes on that capital gain. So here's the beautiful thing. Capital gains taxes are far, far less than ordinary income taxes. So what is ordinary income? Ordinary income comes from salaries, tips, bonuses, rental income, interest income, right? A lot of the stuff that most regular people have. And um, so that's ordinary income. Capital gains income comes from basically investments and things like that. So ordinary income rate, we know, is your regular tax rate. Capital gains tax rate is from 0% to 15% on a scale based on your ordinary income rate. So if you are at the lowest taxable income rate for a single person, is I believe 40, let's see, I'm gonna have to look that up real quick. For ordinary, single, $41,675 if you file single, and $83,356 if you file joint. You pay zero capital gains tax. Zero. No matter how much the capital gains is, you could make $1 million on the sale of something, and if your ordinary income tax rate puts you at that bottom scale of $83,000 for joint, $41,000 and some change for single, you pay 0% on your capital gains. And then there's a scale up to 15%, and that's still lower than, right, ordinary income. The scale for the maximum of paying 15% means your ordinary taxable income for individuals $459,750 single filing, and for joint $577,200. Then the maximum you'll pay is 15% on your capital gains. So that's for all capital gains, right? No matter what you're selling. So what is this section, 121 exclusion? All right, so the exclusion is not for investments, right? This is for your personal home. So if you bought your home for one price and sold it at a higher price, there would be capital gains. But there's a capital gains exclusion, meaning, right, there's an exclusion of a certain amount of the capital gains from being taxed. So but there's a test they call ownership and use test. So for 5 years, right, there's a 5-year period from ownership to sale. Within that 5 years from purchase to sale, you had to have used it for personal use at least 2 years out of the 5. They don't have to be consecutive, but you have to have 24 months out of the 60 months that you used it that you owned it and used it for personal use. Now, both you and the spouse do not have to be a part of the ownership, even if you file jointly and get the full exclusion. One of you has to have owned it and used it for 24 months. If you're filing single, you get a $250,000 exclusion of taxable income. So that means if you gained $250,000 or less, then it's totally excluded. If let's say you gain $300,000, $250,000 of that excluded, you're only obligated to pay $50,000 to pay taxes on $50,000 of capital gain. And again, it's on a scale from 0 to 15% what you'd have to pay on that. If you're filing jointly, $500,000 exclusion, which means that, again, if up to $500,000 was the capital gain, then that's zero taxes. If it exceeded the $500,000, let's say it was $700,000, you'd only have to pay capital gains tax on $200,000 of the $700,000 capital gain. And again, only on a scale of 0 to 15%. So if you're, again, at the lowest level of ordinary income, which, again, when you're thinking about your wealth strategy, you want to keep your ordinary income extremely low. So even when you pay capital gains tax, it's extremely low, if any, right? That's the exclusion, right? It's real simple. So instead of, having to pay capital gains tax on the full amount of the difference between what you bought it for and what you sold it for, there's an exclusion: single, $250,000, joint, $500,000 exclusion. So make sure you have a very good tax strategy. You should always consider that. Anytime you're trying to create income, anytime you're trying to grow wealth, you have to also consider what the tax ramification is for what you're doing and how to minimize your tax liability on everything so you keep the most amount of money. It's not just about earning or generating the most amount of income. It's about how much of that you can keep at the end of the day legally. I'm not saying do anything illegal, but the tax system is set up so that you can minimize your tax obligation. And it's just how you get your income and the strategy that you put together. So make sure you have a very good tax strategist that knows your situation, understands your situation, and can minimize your tax obligation. In general, these little box chain tax places don't do that, right? And it'll never happen if you just use short forms and all these other things. You need to be able to go to someone who has experience with investments or business or real estate, and even if you just have earned income, who can deduct all the things that you're entitled to and create the best strategy for you to be able to create long-lasting wealth that you can keep and hold on to and be able to transfer with minimum tax obligation as well. So hopefully that was beneficial. You understand a little better. Use a professional for your taxes. Don't try to do it yourself. That shouldn't be your focus. Your focus is whatever you're trying to do to create income, and you get somebody who does that 100% of the time. That's their focus. Not a part-time person, someone who can do that full-time, who only does that, who stays on top of the tax code, who can give you the best strategy for you. So I'd love to hear your comments, your suggestions. Please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.